Welcome to the deep dive. We're here to, well, cut through the noise and get you properly informed. Today, we're jumping into something that causes, honestly, a lot of confusion in the financial markets. Divergence. You've probably heard the term, maybe linked with trading indicators. Sometimes it sounds like this magic bullet for spotting reversals.
And that's exactly it. That's where the confusion often starts and where our deep dive really kicks off. We're pulling our insights today from a specific lesson. It's called ICT SMT Divergence, Smart Money versus Right Tail Logic. It's actually set up like a chat between a teacher and a student, which really helps break these ideas down.
Right, so our goal for you today is pretty clear. Figure out why some ways of looking at divergence are, well, frankly, unreliable, what gets called retail logic.
Yeah.
And then understand this other approach, the smart money technique, or SMT divergence. It's supposed to give you this kind of X-ray view into what the big players are really doing.
Exactly. It's about understanding the why behind market moves, not just chasing indicator signals. So let's start with the common one, normal divergence. This is what loads of retail traders learn about first. It usually involves, those mathematically derived indicators, think RSI, stochastics, MVD.
Just standard toolkit stuff.
Uh-huh. And the basic idea is, well, pretty straightforward. If the price makes a new high, but your indicator makes a lower high, that's supposed to be bearish divergence. Maybe a reversal's coming.
Okay.
And the flip side, price makes a lower low, but the indicator puts in a higher low. That's your bullish divergence signal.
Right, I've definitely seen charts showing that. So if it's so common, what's the catch? Why the caution? Doesn't it work?
Well, that's the million-dollar question, isn't it? And this is where the teacher in our source material really pushes back. It's a core critique. The teacher says pretty bluntly, indicators do not drive price. They are merely a reflection of past data.
Okay, so they're just looking backward.
Exactly. Lagging indicators. And the real danger, the teacher warns, is that traders relying on these signals often end up getting clock cleaned.
Ouch. Clock cleaned, meaning they lose money.
Yeah, because the price just carries on in its original direction, completely ignoring the indicator's divergence signal. The teacher's whole philosophy, which resonates with me too, is that the market has no awareness of our indicators. And the teacher adds, my philosophy is that unless concepts are rooted in liquidity and order flow, they are made up or a religion.
Wow, made up or a religion? That's quite a statement. Can you unpack that liquidity and order flow bit for us? What does that really mean in this context?
Sure. So liquidity basically refers to the pools of buy and sell orders sitting in the market at different price levels. It's like the fuel. And order flow is just the process of those orders actually getting filled, buys matching sells.
Got it. The actual buying and selling pressure.
Precisely. So the teacher's point is real market insight comes from watching that the supply and demand, the real money, moving not from calculations based on where the price used to be. Indicators show what happened. SMT tries to show you why it's happening now based on that underlying flow.
That makes a lot more sense. Looking at the cause, not just the symptom. Okay, so if that's the problem with normal divergence, how does this ICT SMT divergence work? You said no indicators.
None at all. That's the fundamental difference. ICT SMT divergence, it's all about observing relationships between correlated assets and correlated markets.
Correlated markets.
Yeah.
Like things that usually move together or opposite to each other.
Exactly. It's described as an X-ray view of real accumulation and distribution. The whole point is to see the underlying actions of smart money. The big institutions, the banks, the funds, with enough capital to actually move the market needle.
An X-ray view. I like that. It sounds much more direct. So let's really hammer down the differences. What are the sort of key distinctions the teacher lays out between these two approaches?
Okay, yeah, there are three main ones. First up is the basis of analysis. Where does the information come from? For normal divergence, it's purely indicator readings. And these are, like we said, mathematically derived, and they measure the past. It's just measuring mathematically a number of bars in the past.
Right, just crunching old numbers. How's SMT different there?
Totally different. ICT SMT divergence is built on intermarket relationships and correlation, but it's looking at actual price action. It's about directly comparing highs or comparing lows in price.
Comparing highs and lows between which markets?
Between different but related markets, often ones that are inversely correlated, like, say, the S&P 500 index and the NASDAQ index, or maybe the US dollar index versus a currency pair like a British pound against the dollar. And the crucial part, the teacher really emphasizes this, is it's done without any indicators, just looking at the raw price charts side by side.
Okay, that's a massive shift, moving from calculation to direct observation. What about the second difference? The purpose and intent. What are people trying to do with each type?
Good question. With normal divergence, retail traders are often using it to try and predict the closing price or anticipate a reversal directly from the indicator.
So using the indicator like a crystal ball.
Kind of, yeah.
Yeah.
And that's the flaw, according to the teacher, because as they put it, the indicator is going to drive price as a retail share. That's what we think, and it's not the case. It's this belief that the indicator signal itself will cause the reversal.
But you said doesn't happen often.
Right. So what about SMT? Is that also trying to predict reversals?
Not directly, no.
Yeah.
This is key. ICT SMT divergence is used as a confirmation tool for a pre-established bias or idea, not a standalone signal.
Okay, say more about that. Confirmation of what?
Confirmation of an idea you already have about where the market might be heading. Its purpose is to understand what is happening on a deeper level.
It helps you figure out if smart money might be quietly accumulating, buying or distributing, selling, often because of their own greed or mistakes in related markets.
Greed or mistakes.
Well,
Interesting. So you see inconsistencies between markets.
exactly. Like one market makes a new low, but a highly correlated one fails to make a new low. That failure, that divergence in price action itself, suggests something is going on under the surface. It confirms your existing idea, maybe to buy, rather than giving you the idea in the first place.
Got it. Confirmation, not prediction. That's a really important distinction. Okay, so that leads us nicely to the third difference. Reliability and context. How trustworthy are they in practice?
Well, based on the teacher's assessment, normal divergence is considered unreliable, plain and simple. The teacher says things like they're all going to flash bear signals, meaning you get lots of false signals, and that leads to traders getting clock cleaned because fundamentally those signals don't account for the market's true liquidity drives.
So they're unreliable because they ignore the real mechanics.
Yeah, it's labeled retail logic and made up precisely because it doesn't align with how the big players, the smart money, actually operate.
And SMT divergence. How does that stack up on reliability?
It's described as powerful and providing undeniable proof. But, and this is a big but, it's not something you just look for randomly all the time.
Ah, so there's a specific time and place for it.
Definitely. The teacher is very clear. It's only really applied when there's a key level influencing price, like an important support or resistance area, or maybe during specific news events when things get volatile. Context is everything. It's about trusting the higher time frame biases first.
Trusting the higher time frame bias. Can you explain that a bit?
Sure. It just means having a general directional idea based on the bigger picture charts like the daily or weekly chart. Are we generally bullish or bearish? And then it's about seeing how a market moves from discount to premium, premium to discount.
Discount to premium. What does that mean?
Think of it like this. Discount is when price is low, below a fair value or equilibrium level. That's where smart money likes to buy. Premium is when price is high, above that level, where they might look to sell. So you use SMT divergence when price reaches one of these key discount or premium areas, and it lines up with your higher time frame bias to confirm that smart money is likely acting there.
Okay, so it's layering confluences. Higher time frame direction, key price level, and then SMT divergence as confirmation.
Exactly. It's that X-ray view at a critical moment.
This is painting a much clearer picture now.
Yeah.
Can we ground this with some real-world examples? How does this actually look on a chart with real assets?
Absolutely. The teacher gives a couple of classic examples. Let's take the pound-dollar currency pair versus the dollar index, DXY. Now, usually these move inversely, right? If the dollar index, DXY, goes up, the pound, often called a cable, tends to go down.
Right, that's the typical relationship.
So the teacher showed examples where the dollar index would make a new high, pushing higher, but at the same time, the pound was unable to go lower than its previous lows. That specific failure, that's the SMT divergence.
Ah, so the dollar got stronger, but the pound refused to get weaker relative to its last low point. What did that signal?
It signaled accumulation of longs by the algorithm, by smart money. It proved that even as the dollar strengthened, smart money was buying the pound. And the source notes this was shown live in markets, not just hindsight. It's seeing that hidden buying pressure against the obvious trend.
That's fascinating. Seeing the invisible hand, almost. What's another example?
Another key one involves the U.S. stock indices,
Right.
the NASDAQ and the E-mini S&P. And often the Dow is included too. Normally, these indices move pretty much in lockstep. If tech stocks, NASDAQ, are rallying, the broader market, S&P, usually is too.
Yeah, they track each other closely most of the time.
But divergence becomes really meaningful at critical times like 8:30 or 9:30 a.m. New York time, especially around major news releases. That's when you might see a cracking correlation.
A cracking correlation, meaning they stop moving together.
Exactly. So picture this. Maybe the Nasdaq went lower, making a new low for the session, but at the same time, the S&P failed to go lower. It holds above its previous low. That divergence, the S&P's refusal to follow the Nasdaq down, indicates underlying accumulation, buying strength. It's that X-ray view of real accumulation and distribution.
So one index is weak, but the other, closely related one, shows hidden strength. It suggests buyers are stepping in despite the surface weakness.
Precisely. It confirms that underlying intent. And the teacher mentions looking at the Dow too, because when all three averages stacked over show these kinds of divergences, it provides really strong insight into what the smart money is likely doing, especially around those key market open or news times.
These examples really do illustrate that X-ray concept. Okay, this is super useful. Now let's get really practical. For you listening, when do you actually use this SMT divergence? And crucially, what are the big mistakes to avoid?
Right. Application is key. And the teacher gives a very specific decision rule. It's this. You only consider SMT when there is a key level influencing price.
Okay, like support or resistance we talked about.
Exactly. And it confirms an idea you've already established based on your higher time frame bias.
So it's never the first thing you look for?
Never. It's a confirmation step. Think about it like this. Let's say you're looking at the daily chart and you think the price is likely to go higher because it just bounced off a major old low, and maybe you saw a bullish shift in market structure. You already have a reason to be bullish.
Okay, I have my thesis.
Right. Then maybe on a shorter time frame, like the hourly chart, as price pulls back slightly, you see this SMT divergence between, say, the S&P and Nasdaq. That divergence gives you that extra layer of confirmation. As the teacher says, it helps you confirm an idea that you had already established before price does what it's doing real time. You're validating your plan, not creating one on the fly based only on the divergence.
That makes perfect sense. It slots into a bigger analytical process. So what are the absolute no-nos, pitfalls to avoid?
The teacher is very clear here. Pitfall number 1, do not go looking for SMT divergence every time you wanted to get a trade or applying it randomly on all time frames. It's selective. It's contextual.
So don't force it if the setup isn't right.
Exactly. Pitfall number 2, and this is huge. Absolutely do not use the old indicator-based divergence for making actual trading decisions. The teacher stresses they can be highly misleading and lead to losses. Just avoid them for decision-making.
Stick to SMT for divergence analysis if you use it at all.
Right. And finally, avoid trying to force a trade just for the sake of taking a trade. If the SMT isn't there to confirm your high probability setup at a key level, just wait. Patience and discipline are crucial.
Okay, that's very clear guidance. So wrapping this up for everyone listening, SMT divergence isn't about indicators. It's about understanding smart money by comparing the actual price action of related markets. And critically, it's a tool for confirming a bias you already have based on higher time frames and key levels, a world apart from the retail logic of indicator divergence.
Couldn't have said it better myself. This foundation, this understanding, gives you a deeper, more informed understanding of market behavior. It's properly rooted in liquidity and institutional order flow, not just, lagging math or wishful thinking. It genuinely helps you, as the teacher puts it, see what's truly happening before it happens, or at least as it's happening under the surface.
Yeah, and that final piece of wisdom from the teacher really sticks with me. Consistency doesn't come from trading indicators. It comes from understanding what you're looking for in price action itself.
Absolutely. It's about stripping everything down to the core concepts, understanding the real mechanics, and then building your own unique model from there.
So maybe the final thought for you to ponder is, what might your unique trading model look like if you shifted your focus away from those surface level indicator signals and towards the underlying market dynamics, towards what the smart money might actually be doing? Something to think about.